China has repivoted back towards exports. So exports are up $1 trillion over the past 4 or 5 years. Imports have hardly moved at all. It's impacting the entire world economy. It is impacting manufacturing sectors in emerging economies. It's really impacting Europe. And it is impacting the U.S., even though we've got pretty severe tariffs on China. China's racking up gigantic surpluses. A portion of that surplus is being recycled through Chinese state financial intermediaries. And this is just an important global force. I do think there's enough opacity that it is fair to think that China could be buying more gold than they've officially reported.
This episode of Monetary Matters is brought to you by VanEck's semiconductor ETF, ticker SMH. As you may know, SMH is the largest semiconductor ETF by AUM, with over $25 billion in assets under management. But what you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that's been intelligently designed to capture low capex, high-margin chip designers, setting the next stage of AI. You'll hear more about both later in the show. Let's get into it. I'm joined once again by Brad Setzer, the Whitney Shepardson Senior Fellow at the Council on Foreign Relations. Brad, welcome back to Monetary Matters.
Oh, thanks for having me back.
You're a specialist on balance of payments. You've worked in the White House as a senior advisor to the U.S. Trade Representative and also as a Deputy Assistant Secretary for International Economic Analysis in the U.S. Treasury. So when we talk about balance of payments, which is what we're going to be talking about today, we're talking not just the flow of goods and services, so trade, but also capital flows. And Brad, I want to get into the consequences of tariffs and trade on capital flows and the dollar. But just to start off, I want to ask you about China. Can you put into frame how maybe the most salient issue for balance of payments over the past 25 years has been China and its chronic trade surpluses? Just how, why are these surpluses so important, and to what degree are they a cause of, or maybe a reflection of, severe imbalances in the global economy?
I think everybody is aware that China, over the past 20 years, has become an export superpower, frankly, a manufacturing superpower. With the announcement about its new export control regimes, it's starting to try to weaponize in a lot of ways its manufacturing dominance. And so on one hand, this is the growth of China's exports. The fact that China runs a big trade surplus isn't new. It was an important feature of the global economy right after China's WTO accession between 2002 and 2008 in our global financial crisis. The surplus moderated a bit as a share of China's GDP after the global financial crisis, partially because we were on our backs, we weren't importing as much, partially because China did a big stimulus that pulled a lot of manufacturing capacity towards its domestic market. But really, over the past 5 or 6 years, China has reoriented back towards exports. So exports are up $1 trillion over the past 4 or 5 years. Imports have hardly moved at all. I mean, really almost no change, roughly $100 billion increase in manufactured imports over a 5 or 6 year period. So China's manufacturing surplus has just soared. Its customs goods surplus has gone from 400 or 500 billion to 1.2 trillion. And these are changes that are of the magnitude of a percentage point of world GDP, or at least a percentage point of GDP if you exclude China and just focus on China's trading partners. They're having a profound impact on, say, Europe and on Germany. It's actually deindustrializing parts of the emerging world. Chile had to close its only steel foundry. Indonesia is having trouble competing with China, not at the top end of the manufacturing distribution, but at the lower end in apparel and some textiles. So it's really been a huge shift. And it is corresponded with domestic weakness in China, a decision by President Xi not to stimulate the household sector, not to do much to support household consumption, but rather to provide a lot of credit to manufacturing after the property market went down. And it's coincided with very low interest rates in China and a weakening of China's currency. For a while, you could argue that weakening of China's currency was simply a consequence of the U.S. raising rates and China lowering rates. It wasn't due to direct intervention in the currency market. And at times over the past 5 years, China's actually propped up the yuan. But I think it's been pretty clear over the past 12 months that the direction of pressure has changed. And apart from April, when, Liberation Day, US tariffs, crazy escalation on China, apart from April, more or less, China's been buying foreign currency. Now, what's interesting from a capital flow point of view is that China used to just intervene through its central bank, the PBOC. The actual currency is generally held by the State Administration of Foreign Exchange, which is part of the PBOC, SAFE. And then SAFE would basically buy US bonds, European govies, sometimes treasuries, sometimes agencies. That has kind of changed. The mechanism of intervention, in my view, has shifted to the state commercial banks. They're all government owned. I think they take guidance from the daily fix that the PBOC puts forward, but they're doing this on their own balance sheet. And when they accumulate foreign currency, they don't just recycle it into treasuries. They are commercial banks. They do more diverse, more interesting things with the money, things we actually don't fully know, a little harder to track as well. But I think we're once again not only in an era where China's racking up gigantic surpluses, but we're in an era where a portion of that surplus, not all the surplus, but a portion of the surplus is being recycled through Chinese state financial intermediaries. And this is just an important global force. It's impacting the entire world economy. It is impacting manufacturing sectors in emerging economies. It's really impacting Europe. And it is impacting the US, even though we've got pretty severe tariffs on China. I think one of the reasons why you actually haven't seen, setting pharmaceuticals and gold aside, much adjustment in the US trade balance is because, Chinese goods are still pretty cheap and you can get Chinese goods, or at least a lot of Chinese content, by importing through third parties. So it's making it very, very hard for the rest of the world to move towards more balanced trade because China's own economy has become so reliant once again on exports. And then the magnitudes are just kind of uh, crazy. Trillions, not hundreds of billions.
And the other side of China's trade surplus is its with all the money it invests that in the rest of the world. And it used to be mostly U.S. Treasury. So you said now they're diversifying to other markets, and they used to do it with the People's Bank of China. Now they're doing it with banks that you and I could buy stock in that bank, but basically it's controlled by the government.
Yeah, I mean, I guess the Bank of China is a red chip. It's listed,
Hmm.
but it's the Bank of China. It is
Yeah.
actually controlled by Huijin, which is reports direct, as part of the China Investment Corporation, reports directly to the State Council. ICBC, Industrial and Commercial Bank of China, another huge bank, same exact ownership structure. I mean, these are state entities; they are not private entities. I guess the other component of the recycling, and it's an important one, is that it used to be that there was a lot of foreign direct investment going into China. So there was money on top of the trade surplus. Now, foreign direct investment is kind of going out of China. China is allowing its companies to invest in the rest of the world, encouraging them to invest in the rest of the world, actually. BYD building factories in Europe, but also a lot of investment in emerging economies. And then a lot of investment in Malaysia and Vietnam to kind of get around US tariffs. And then foreign companies used to want to expand their operations in China, and they wanted to hold their cash often in China, partially because it's hard to move money in, partially because you got a better interest rate in China typically than you got outside of China. That has all changed. So for a while, foreign direct investors were taking money out of China. Now they're just really not putting much in, and Chinese investors are taking money out. It's a couple $100 billion net outflow. So big. And then on top of that, you have dollar accumulation by Chinese exporters abroad, which is recycled through the global financial system. And now you're seeing dollar accumulation onshore, a couple hundred billion in the Chinese state banking system, which is also recycled. And some of that flows to like standard loans. Some of that goes invested into a more diverse security portfolio that's kind of hard to track because they don't use the New York Fed as a custodian. Some of that is just going into global funding markets, cross currency swaps, you name it. The Chinese banks have $1 trillion foreign currency balance sheet. So, they're big players.
Mhm.
similar to the Japanese commercial banks by this stage.
And as you referenced earlier, Brad, you've compiled actual data on what has happened with the U.S. imports and exports. As we are approach the end of 2025, and in terms of export volumes, there isn't a whole lot of change in terms of total U.S. exports and imports. I guess there was a huge surge of imports in the first quarter as people were kind of front running tariffs. But what has changed, and we could put these charts on screen, is just the composition. The imports have not changed all that much, but it is increasingly not from China, and it is Asian countries, and including Taiwan. You can see it in the green chart that we'll put up for our viewers. So, how much have these tariffs actually impacted the global trading situation, and to what degree does it matter if we're buying something from Vietnam instead of from China?
All right. Frankly, it doesn't matter that much if we're buying from Vietnam rather than China if all the key components in the good from Vietnam are still coming from China. It would matter a little bit if there was a real substitution, if it was a lot of Vietnamese content. But I think the available evidence suggests that this is final assembly outside of China of Chinese made components, of Chinese made goods. So, in that sense, it doesn't change China's aggregate trade surplus. It doesn't have that big of an impact on Vietnam's economy. It doesn't make Vietnam all that much richer. It doesn't allow Vietnam to import that many more goods. A little bit, but not a lot. It doesn't change underlying dependence on Chinese components, China's capacity to do export controls. So, I mean, in that sense, I think it's been a much bigger optical shift than a real shift. It could lead to something that is more significant over time. When China first started doing final assembly, a lot of the key components were still coming from Japan and from Korea and Taiwan. Now, the top end chips still do come from Korea and and Taiwan. The best optical sensors still come from Japan, but China clearly is making an awful lot of its own components now. It's not relying as heavily on imported components. So assembly became the basis for now an almost complete industrial supply chain. That maybe will happen with some of the Southeast Asian countries. So it's not irrelevant, but it is not yet an important and significant change. It gets way overplayed. The way I would look at the evolution of US trade is as follows. Ironically, the big front running came in two areas where it looks like we're not going to have any damn tariffs. Pharmaceuticals, where the administration has said they're not doing tariffs on generics, and after the deal with Pfizer, they've kind of signaled they're going to do deals with all the branded pharma guys and not going to do any near tariffs. So you have this huge swing in Q1, which is almost all pharmaceuticals, and then you have a reversal in a product area that is actually not going to end up being tariffed. You similarly had a huge surge in imports of gold. Uh, and then now it's very clear, gold and gold bars, that gold is also going to be excluded from the tariffs. And then you've seen some of that gold flow out. So it's the big swings in visible trade, apart from the shift in final location of some Asian consumer goods, have come in categories that are not going to be tariffed. In the categories that are heavily tariffed, you are starting to see some weakness in imports. You are seeing a little bit of a slowdown in auto imports. Now, we have a problem because the detailed data should have been out, but it's not out because we have a government shutdown. And our data itself is kind of lagged, so we're sort of slow. So we don't really have as contemporary a set of data as you would like. But you can point to sectors like autos where you're starting to see some reduction in US imports. Now, you're not seeing a big uptick in US production, you're just seeing a general slowdown in the auto sector. But you also can see sectors, and this is partially driving Taiwan, although Taiwan is also rerouting out of China. Sectors that are supplying the AI data center capex boom, you've seen a clear pickup in imports. So when you net it out, it looks like imports are going to be slightly up on the year. Part of that is still driven by the pharma export import boom. The reversal hasn't been complete, but in terms of like a massive shock, this is not a shock to global trade like the global financial crisis. It's not a shock like COVID. It's been a huge shock to the global trade rules. But as of now, it hasn't really forced major adjustments in the global economy. The adjustments that it have forced have been these changes in the location of final assembly. Now, it is certainly possible over time that it'll have a bigger impact. It is also possible if we rebate all the tariff money, or if we keep doing deals to kind of with big companies to mitigate the impact of the tariffs, that it won't have that significant an end of result. But as of now, it's not forced a change in Asia surplus. It's not really led to a big fall in the U.S. deficit. It has actually put a bit of pressure on Europe and Germany and German auto manufacturers at a time when they're down because they're getting walloped by the fall in their Chinese export market.
So, save for gold and pharmaceuticals, the volumes of imports and exports haven't really changed all that much. But what has happened is that those imports have been charged at tariff rates, maybe not as high as was announced on April 2nd, Liberation Day, but still rates that a year ago we would have considered very, very high. What is happening in terms of the tariff incidents? Are the importers, basically the companies, are they pay the tariff? Are they passing that cost along to consumers? Have they not done so? What are your views about in 6 months, a year, 2 years, how much of those costs will have been passed on?
So, we import, excluding oil, about 10% of our GDP. The tariff revenue right now is about a percentage point of GDP. So, solid, actually a little less than you would expect based on the announced tariffs. So we aren't collecting everything, arguably, we should be collecting. But there's an awful lot of exclusions. So calculating the exact level of the tariff is, I think, a very difficult task. This is actually one of the areas where the government shutdown matters, because one of the data points that would have been released a day ago or 2 days ago with the trade data would be details about where the tariff revenue is being collected from. So we know how much is coming from China, how much is being collected on it. It's not coming from China, from Americans who are importing goods from China, from Americans who are importing goods from Canada and Mexico. Because, most USMCA compliant trade has an exclusion, but not all of it. How much is being collected on goods from Europe? And with the data for August and September is going to be important there, because this is after all these deals, after kind of the base tariff in a lot of cases went up from 10 to 15. Now, when it comes to incidents, you can rule out foreigners paying it. Foreigners technically don't pay it; it's paid by the importer, and we just haven't seen import prices come down. And the August data did come out for import prices. Import prices actually ticked up a bit. So you just don't see a fall in import prices, which would be the way foreigners would absorb the tariff costs. It's just not in the data. It is equally the case that a lot of it hasn't been passed on to consumers yet. Maybe 20% or 20 bips of the 100 bips of GDP. And it's not quite the same, but the import share of the CPI is, I think, 11%. Import share of U.S. economy is like 10. It's just not that materially different. So you kind of can do a rough congruence. So it looks like most of it has just been absorbed by companies for the time being. You see that in the auto profits. You see that in the statements coming out of Ford and GM. They are not happy. That's why they've been asking for more tariff relief. And I think you're going to see that in other corporate disclosures. It should have an impact on their bottom lines. Over time, and I think this is something that Chair Powell has said, is something that the economic research team at Goldman has pointed out, you would expect 60%, 70% of this to be passed through to the final consumer. I think that's coming. So I think, roughly a half point, that's not small, but it's not giant, is still coming through to be absorbed by the consumers, if tariffs stay roughly where they are.
Hope you're enjoying today's episode. Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC, through the equipment makers and software developers. Its market cap-weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHjack to learn more. Building on the design and success of SMH, VanEck saw an opportunity, and it launched a fabless semiconductor ETF, ticker SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimizations and applications at the edge. Go to vaneck.com/SMHXJack to learn more. And now back to the interview. So it's a 40% effective tariff rate on China, and the imports from China have gone down. Do you think they will approach zero or continue to go down? Because you think of how narrow profit margins are, particularly in factory goods. Wouldn't you think that the elasticity to tariffs would be higher? And if they're not, is that evidence that China is kind of dumping in a non-economic way?
Look, there are places where China's domestic market is quite competitive, but there isn't a supplier outside of China. So you saw that with the 25% tariff, there were still some firms that were paying the 25% tariff because they just needed the component. They needed the motor, and there wasn't an alternative. There's competition inside China, but not competition with someone outside of China. So empirically, the 25% tariff reduced trade in those products by about 50%. You apply that to a 40% effective tariff, and you're going to get an 80% fall in trade. Now, if you do it on those components that are tariffed at either 20 or 30, you're going to get a fall in those products of trade of about half. That's big. So, but it doesn't suggest yet going to zero. To go to zero, you need to be above 50 on pretty much everything. But the other important point, and I would kind of disagree with everything from China's like low margin stuff.
Mm-hmm.
It's low margin because China's internal market is so competitive because they are oversupplying, but it is critical. There's often not an alternative. That's why they have leverage on the export controls. The reason why you're seeing pretty high elasticities is because it's relatively easy to set up a location of final assembly outside of China that uses 95% Chinese parts. Get 2 screws from Indonesia, do final assembly in Malaysia, and under current tariff rules, that's a Malaysian product.
And that
Now,
isn't technically transshipping, which, as you have said,
no,
transshipping is illegal.
it is actually technically not transshipping. That's a mistake. Sorry to get mad at you, but I'm not mad at you. I'm mad at everyone who uses this term. I'm mad at Jameson Greer for perpetuating this myth, although he knows better. It is not transshipment. Transshipment is you take a good in a box, send it to Malaysia, take it out of the box, put it in another box, and label it as Malaysia. That's illegal. If you ship parts to a third country and the parts are in a different tariff code than the final good, that is all it takes to be in the final tariff category. If you put in any additional components from third parties or from the country doing final assembly, that is all it takes under the current rules to be a product from that country. The rules of origin and tariff shift rules are really very, very loose. Now, as part of the so-called transshipment debate, there's talk of putting in place a de facto, a Chinese or non-market economy content limit at 40, which might work. That would be a much bigger constraint.
What do you
Now,
mean
there's
40,
something
40 billion or?
40%.
Okay, yeah.
40% tariff rate. That was the discussion. Now, that's strange because most goods now coming in from China are coming in at either 37.5, the 7.5 plus the 30, 27.5, or 20. So 40 would be higher. So the incentive would be then to stay in China. That's what I kind of mean, that like we're kind of Swiss cheesy and we don't really have, in my view, coherence because there have been so many different, tariff structures put forward. And this embedded Chinese content limitation or embedded non-market economy content. Now, non-market versus China is important because Vietnam's a non-market economy. So we'll see how that one works. That hasn't been finalized. So we will see. And then, of course, there's the court case, which might toss out all these tariffs except the sectoral tariffs. So, there's just a huge components there. I do not actually think trade with China is going to zero. But more importantly, if you don't look at just direct trade with China, if you look at embedded Chinese content, my view is actually embedded Chinese content has gone up relative to the Trump 1 trade war because there's so many more Chinese components coming in goods from Southeast Asia, more and more Chinese content and imports from Europe, more and more Chinese content and imports from Mexico. That's not transshipment. That is just parts being sourced from China. China's manufacturing dominance. It is a myth to think that China can run a $1.2 trillion trade surplus without supplying the US market. They're going to, you're going to get embedded Chinese content. We don't yet have a coherent overall approach to solve that. And to be honest, I would much prefer that we focus on reducing dependence on China in important strategic sectors where there aren't alternative sources of supply, rather than trying to do it comprehensively. So, I mean, there are big issues there.
When you say China can't run a $1.2 trillion surplus without supplying the US market, you mean directly or indirectly, and that a large part of that can be them running surpluses with Vietnam, other countries that then have a surplus with the US. So it's an indirect.
So there's two mechanisms. It's sort of shipping parts. Think of it as chips, think of it as circuit boards, think of it as motors, optical sensors, you name it. Solar, it's either the polysilicon, the wafer, or the cell, and then it's just put into a panel. So it's in many cases the more technologically important parts that are coming from China. With chemicals, it's chemical precursors or active pharmaceutical ingredients that gets packaged into a pill in India. So that's Chinese components coming in through third parties. There is also a more indirect effect where China supplies the consumer goods market in Europe, and that frees up European production to be exported to the US. So that's more deflection. And both are factors.
And so that is the world of goods and trade surpluses, current account surpluses, which include services. Now let's talk about capital flows. What has happened with all the surplus countries? What have they been doing with the money? Are they still deploying money into the U.S. Treasury market and the U.S. Financial market? There was talks during April and May that there was some pullback. The dollar weakened, strengthening somewhat over the past month. The U.S. stock market has done extremely well in euro terms. Maybe it has not done as well, but just as someone who's not even looking at the stock market or anything, but just looking at the capital flows between countries, what are you seeing?
So there was a fall off in demand for U.S. bonds. Fall off doesn't mean things went to zero, but I think you could say, maybe over the past 5 years, on average, foreigners were putting 2% of US GDP into the treasury market. Actually, like 1.5% of US GDP, and that's probably fell to about 1% of US GDP. So, a fall off, not a collapse. Some of that was always hedged. Maybe the hedge ratio on that has gone up. Hedge ratios just mean that the person holding the dollar is holding a short-term dollar, and they're lending that short-term dollar to the person who's buying the bond. So it separates out the holder of the dollar from the holder of the bond. The bond holder isn't taking the dollar risk. They're taking the risk between their short-term borrowing costs and the return they get on the bond. You've seen continued inflows, and we'll see if some of the recent blowups in private credit impact this, but you've seen flows into U.S. corporate debt, private credit, continuing like 1% of GDP-ish levels. And then the big thing that has led the dollar to stabilize after April, part of it was that the Trump administration made it when they did the deal with China, when they delayed, when they did deals with Europe, when they let most USMCA trade come in tariff free, when they basically are exempting now electronics, so all the AI equipment and pharma, they sort of pulled back a bit from tariffs uber alles. And they're still really big tariffs, but they kind of pulled back a bit. They've de-escalated from China from the 145, so it no longer seemed like the administration was willing to throw the U.S. into a recession to make a point about tariffs and changing trade patterns. And then foreigners started buying the dip in the U.S. equity market, and they've seen really record inflows into U.S. equities. There's some measurement issues. There's a question about whether some of these flows are hedged. But you really saw from June on really unprecedented, at least since the dot-com era, consistent with the dot-com parallels, flows into U.S. equities.
So you had a weakness in the dollar that could be evidence of a somewhat reduced demand for U.S. assets, but it's not it's not proof at all. One thing that's certainly sending a stronger message is the price of gold, which is briefly yesterday over $4,000, a huge appreciation in a very short amount of time. What does that indicate about foreign demand for U.S. Treasuries? Are they looking at gold as a diversifying asset? When we did an interview, you said, okay, yes, they're buying gold maybe a little bit more, but it's only on the margin. Is it still on the margin if gold has gone up so much so quickly? And I'll also add that even though you have seen some modest inflows into U.S. ETFs and assets, and this is something that I track. Like it's clear to me that whoever is buying it is not a U.S. retail investor, because you're not having a huge surge in the AUM of like U.S. ETFs as you did in like 2010 or 2011. So I don't know who's buying, but I know it's not particularly the U.S. retail investor. So maybe it is China. I don't know. But what do you think?
That's interesting. I actually would have thought it would be more U.S. retail.
I'm just talking about gold, not stocks. Yeah.
Oh, okay,
Yeah.
gold. Yeah. I was thinking stocks. Look, on gold, you track it better more than I do. I still think it's the central bank diversification is into them at the margin. Like China's overall holdings of foreign exchange haven't gone down. If you include the state banks, their overall holding of foreign exchange, so like traditional financial assets, have gone up. At most, they're taking the interest income and putting it into gold. Now, gold's a pretty thin market. It doesn't take that much of a flow to push the market up. There are probably other central banks that are also looking to diversify. I don't think it's a. I think it is a slow burn reaction to the sanctions on Russia, which basically showed that any of the G10 financial assets were sanctionable, and the only sanctioned secure financial asset a country could hold was gold, unless you're close to China like Russia, and you can have some of your financial assets in Chinese yuan. But yeah, hey, Chinese yuan, China doesn't want it to go up. The interest rate on Chinese yuan isn't that much higher than the interest rate on gold, so maybe you like gold better. And so I do think a subset of central banks put money in, and my sense is just momentum took over. I'm a bit surprised there hasn't been more retail interest. I thought that was driving it. And then I do think some big institutional investors, not central banks, started looking at it as a broader hedge in a world where the bond equity reverse correlation didn't hold in 21 and 22. I think bonds are actually probably going to be a pretty good hedge going forward, because bonds, there's now a coupon, yada, yada, yada. But in the face of an inflationary shock like 21, 22, a supply chain shock, bonds didn't work as a hedge. And so I think there has been an appreciation by some institutional investors uh, to the hedging properties of gold, should there be a replay of those kinds of shocks. And then, as long as you're rewarded with higher prices, you're not there hasn't been much of a cost. So I'd be a little bit worried that now there's a risk that what you thought of as a hedge, i.e. gold, is now going to turn out to be more correlated with equities than you expected.
Yeah, gold has been going up alongside stocks, which is something I don't think you see that often. So Brad, in terms of the
So it
actual
feels to
data,
me like momentum is driving a
yeah,
little bit of both. But
yeah, I think for sure. So when you're looking at the data of foreign reserve managers, so central banks, sovereign wealth funds, holdings of gold, I've seen these charts. You've seen these charts of that gold holdings are going up, whereas U.S. Treasury holdings are flat. Does that include the valuation difference? Because if I own a certain amount of gold and I don't buy any more gold, but the price doubles, it will look like my holdings have doubled, and they have in value, but that's different from actually net buying. So when you see these charts of gold reserves, it's important. Does that include revaluation?
in general, yes. And
Okay.
in general, it's like, the U.S. has more gold than anyone else, so our gold stocks have gone way up. Europeans have always held a lot of gold; they're not adding, but that valuation has changed. Now, there are individual central banks that have been adding to their gold. I mean, the Turks are probably, you know, Turks have always held a lot of gold, and they're continuing, I think, at the margin to buy. China is at the margin, clearly adding. There's a lot of chatter that China's official data understates their actual purchases of gold. Because you look at the actual purchases, they aren't that significant, and most of the increase is valuation. And then you look at overall global dollar holdings, you know, they're flat. They're not going down. So there hasn't been a reallocation away. Uh, and then where I would say the real money is, yeah, there's some money chasing gold. Some central banks have diversified into gold, no question. It's a thin market. The real money, in my view, is there in Chinese state banks, a couple hundred billion increase in their holdings of financial assets. It's in sovereign pension funds. Korea is adding to its sovereign fund. Qatar, UAE, they have money that's still going there. Saudis, no. Saudis has a current account deficit. They're actually borrowers. But the general shift has been away from central banks as a vehicle for accumulating foreign exchange by surplus countries to kind of quasi sovereign investment vehicles, state banks or sovereign funds. I still think that's a bigger global flow than the flow into gold, but the gold flow, because it impacts price, is much more visible.
But whether it's the People's Bank of China or state banks, kind of on behalf of China, it still is a Chinese financial institution, right? That I guess that is who's the holder rather than what is the asset.
Yeah. I mean, SAFE, the central bank, tends to hold more treasuries and agencies. The banks tend to do more corporate lending, hold more corporate bonds, do more cross currency swaps. SAFE does cross currency swaps too. So there's a asset composition. But yes, it's all ultimately China's state government. And at least in my view, there are mechanisms which are poorly understood, but kind of visible. Most importantly, the daily fix and the fact that the CNY hasn't traded stronger than the fix for a long time, and you see state bank buying right at the fix. So it feels like the fix has become this big, important coordinating mechanism. But I think it is also a coordinated policy response. It's not just the state banks on their own deciding to buy, it is the state banks reading signals from the authorities. They are also owned by the authorities. Their management is appointed by the Chinese Communist Party. And so it's in that sense, not in every sense, but in that sense, I think China is effective at coordinating across, at the end of the day, 10 big state accounts.
And you retweeted Adam Tooze, who was talking about a Goldman analysis that China was basically buying a lot more gold than it officially reported People Bank of China purchases. And you wrote about what you said earlier about how People's Bank of China has $100 billion a year to play with in terms of, I think, interest income. So that is a big market. I mean, that was more than a few basis points relative to gold for sure.
Look, I mean, there's just been a long-standing mystery about where China puts its interest income. It doesn't actually show up on the PBOC's balance sheet. The balance sheet measure has been flat. Reported foreign exchange reserves on SAFE's balance sheet using their kind of disguised metrics. So you kind of have to look at the PBOC balance sheet in CNY and understand it's reported at historical cost. But when you do those adjustments, those have been falling by 10 billion. Plus, you got whatever, roughly 10 billion a month, maybe a little less, in a spiky in interest inflows. And we've never seen the interest income cleanly, and so it's a long-standing mystery. So there are pools of money in China that are a little more opaque, and where they could be invested by SAFE but not counted as their reserves. They could be handed over to some SAFE-controlled investment vehicle and therefore not considered formally part of reserves. There's lots of potential mechanisms, and we know these things exist. We know that SAFE has done so-called entrusted loans with CIC and CDB. They converted those entrusted loans into capital back in 2015, 100 billion. That never showed up on the balance sheet. They put a lot of money into the Silk Road Fund, to other funds that support the Belt and Road. Again, that's money that disappears out of reserves. We know it is in these funds because the funds have reported that they got money from SAFE, but there's no line item on the SAFE balance sheet you can point to. So I do think there's enough opacity that it is fair to think that China could be buying more gold than they've officially reported.
And the Chinese yuan that we referenced earlier, the CNY, has weakened against the dollar relative to this year, a little under 3%. And a weak currency stimulates exports, and so the fact that the yuan has weakened against the dollar makes U.S. exports a little less competitive and Chinese exports a little bit more competitive. And I've seen you write about how actually relative to other currencies, and especially on a inflation trade weighted basis, the Chinese yuan is actually very very undervalued. Just how extreme is this undervaluation? And it's the C word, the cheating at trade. I don't want to get into that, but like, to the extent that China is cheating at trade, how big of a component is the very weak currency? And are you and President Trump aligned in that the Chinese should strengthen its currency, and how successful? What are the odds that you think the administration could achieve that, or that the Chinese government would be willing to strengthen the yuan?
I think I'm actually much hawkier and more serious than President Trump about this issue. I mean, he hasn't talked about it in years, not years, months. Peter Navarro talked about it at the end of his last term, but there's been no sustained pressure on China around currency issues, no pressure on Japan, no pressure on Korea. President Trump seems to want to do these investment deals, which I think are wacky and crazy and not very good. So I actually think I'm much more serious than President Trump. I resent the suggestion that I am just President Trump.
Even more so.
Yeah, I'm much more so. I'm much more serious, much more real, and have better plans. Frankly, I'm sort of disappointed that a hockey sounding president hasn't actually focused on this issue. It's a real issue, and it's a real issue that China doesn't rebalance its internal economy. It is a real issue that the yen is at 150. I don't know why the president wants all this Japanese money to go into an investment vehicle that Lutnick controls that's going to be caught up in endless disputes because U.S. and Japanese incentives are not aligned, instead of focusing on the currency. Because if the currency moves, Japanese companies will invest in the U.S. because it is in their corporate interest to do so. So yeah, we're not thinking about this in the same way. We both want adjustment, but I actually think I have a much more credible set of policies and plans than Trump or his administration this time. I think Lighthizer would be more serious and more credible. So I'm not going to give President Trump a bit of credit here. I think he's walked away from what should have been a central plank in his agenda if he's serious about rebalancing.
Sorry, that's good to know. So yeah, I had heard President Trump speak, somewhat forcefully about we need a weaker dollar. If you do the math, a strong dollar sounds good, but actually a weak dollar is better for exports. And I thought he was on the same road as you. You're saying he hasn't talked about that in months, and he's kind of walked back about that. That's good to know. I didn't know that.
Yeah, no, I mean, and all these, the Koreans are saying correctly that the only way to make this investment deal work is if the won stays weak and they get a swap line. The talk about not liking a strong dollar was much more at the end of Trump 1. It's been very light this term. Occasionally you heard it, but not very often. You've heard an awful lot more talk about dollar dominance and stable coins generating dollar inflows. So I'm just not seeing it. We've done technically currency deals with now Korea, Japan, and Switzerland that are reiterations of IMF commitments plus a statement to the effect that their sovereign pension funds will not be managed to impact, not to impact, they won't be directed, they won't target the exchange rate. Well, of course, they're never going to target the exchange rate. They may impact the exchange rate. The governor of the Bank of Korea has said they impact the exchange rate, but they're always going to say they're targeted investment returns. So I think the Treasury needs to put out a policy statement saying what they think these currency deals, which have gotten no attention because they basically say nothing, what they think these deals have achieved, because they haven't focused on the undervaluations. We'll see what Treasury does in the October foreign exchange report. The April foreign exchange report was a nothing burger. They've promised some methodological changes, which I'm sort of excited about. But the deals that have been announced are irrelevant. They're not pushing the frontier, and the investment deals imply continued weakness in Asian currencies. So we'll see. Yeah, it's fair to say I'm not impressed. Not at all. And I'm disappointed that we haven't had more of a focus on currency in the negotiations with China right now. The yuan, right, it's actually technically started to appreciate over the past couple of months, and that's when you really see state bank intervention to keep it from appreciating more. It has depreciated very, very significantly against Europe because the dollar's biggest move this year has been against Europe, not against Japan. It has depreciated a bit against some other emerging currencies, and it is down 5-6 points in real effective terms. It is down between 15 and 20% in real effective terms from roughly 21. And so, to my mind, if you just look at it on a trading framework, not a capital flows framework, and capital flows don't matter in my view that much because I think China actually does control its financial account, and most of the big financial flows, not all, but most are kind of state managed. It's sort of 15 to 20% undervalued in real terms now. 15 to 20% standard trade elasticities, 10% is 1.5 percentage points on net exports. So that's, somewhere between 2.5 and 3 percentage points of higher trade surpluses because of this. I don't think it's a coincidence that since the CNY started to depreciate in real effective terms, China's been getting a 1.5 percentage point contribution on average from net exports. It actually got a little more last year. It's a little lower this year. There's some huge measurement issues as always, but you've really seen strong growth in Chinese export volumes, no growth in imports, and much faster growth in Chinese export volumes than global trade. All these are data points that are consistent with an undervaluation that drives trade. Now, the counter argument around all this is that China still has deflation. There's some people who think you should direct monetary policy at fighting deflation. You should be cutting rates. And if that means a weaker currency, so be it. The way you solve deflation and the legacy of the property market is by exporting your way out. And my challenge to them is, you really think the world can accept an even bigger Chinese export surplus? That doesn't feel right to me. It seems to me that when you're out of external balance and out of internal balance, you have a big external surplus and deflation, the right response is fiscal. But that's kind of the debate. But I actually get pretty, using standard IMF certified quantification criteria in the real depreciation just over the past few years, I get a pretty big impact on China's exports and on the surplus.
Mm. And tell us about these investment deals that President Trump is focusing on. Just how big are they? I mean, the South Korea deal, is that a $350 billion deal? And it's so big that the South Korea says it needs a swap line. Just explain the logic behind these as well as your criticism of them.
I'm not sure there is any logic. I don't think they're very.
Okay, well,
Yeah.
I'll suppose just the logic is
They-
other countries need to invest in the U.S. And even though on paper, the economic, eggheads, for lack of a better word, like we have a huge investment from the rest of the world. It's mostly into stocks and bonds, not into foreign direct investment. So like, let's have the rest of the world invest and build factories in America and the central. That's the pitch. What's wrong with that?
Look, if you believe in America first, why do you want the future profits on America's capital investment to all flow to the rest of the world? Why shouldn't those profits flow to American companies? And why can't American companies, incentivized by market incentives and US policy, generate this investment? And if we want foreign direct investment, why can't we get that investment not through government directed deals, but by an exchange rate like happened in the 1980s, which leads Japanese and Taiwanese and Korean companies to put money into the US? There are certainly sectors where the US is lagging, like chips, like, with the TSMC deal. And in those sectors, I think US industrial policies that are not based entirely on government to government deals, where, there are investment incentives, but those investment incentives, a portion of the CHIPS Act was just a tax credit that was available to anyone. There were additional investment incentives, but those were coming from the US taxpayers. And where I differ from President Trump is when something is critical to the US national security, like building advanced chips, like building critical minerals, investing in rare earth permanent magnets. I actually want the incentives to come from the US. I want the US to be in control, not other countries to be in control. Now, the Trump administration says that other countries have agreed to put up the money and have the US control the flow of funds, and that they've agreed to let the US get the lion's share of the profit on these investment deals. I have never, in my experience, and it doesn't include a lot of private equity experience or any, it's mostly, bonds and currency. I've never seen deals where the person who puts up the money isn't ultimately in control. Moreover, when you hear what the other governments say, they are talking about very, very tiny amounts of actual commitments of government funds from their side. Couple single digit billions on the Japanese side that's supposed to incentivize this 500 billion. There is a gap between what other countries think they've committed to do and what the Trump administration is selling this as. Moreover, if it is real, it is just an invitation to continue to have currency weakness, to continue to run current account surpluses, to channel into these funds, and then have them directed by Howard Lutnick without congressional scrutiny or supervision outside the appropriations process into various projects which may or may not produce a real return. So I do not understand why these are so good for the United States. The president obviously loves them. The ones from the Middle East are pretty clearly fake. The one from Europe was just Europe telling you more or less what European companies think they're going to invest anyway. And we will see if the Japanese and Korean ones materialize, or whether the Japanese, as Politico has reported, plan to slow walk this because they have no real intention of putting up funds for projects which Japanese companies don't really want to do. So we'll see. I'm skeptical, but I think the baseline here is if you really believe in America first, and if you really believe in American national security, you put American money into sectors that are critical for American national security, and you don't rely on other countries to fund your defense and your economic defense.
Thank you, Brad. Just before we start,
Rant
yeah,
over.
no,
But you can see,
yeah.
like, I actually think that we weirdly ended up in a backdoor globalist administration that is supporting continued imbalances by not taking on Asia on currency issues and instead wanting to channel investment flows through state guided investment funds. I mean, that's is a weird mix.
Yeah, I understand that criticism. Brad, right before we started recording, you noted that Treasury Secretary Bessent had finalized or said that the $20 billion U.S. Argentina currency swap line had been finalized. Brad, I'm so far behind on this, and I imagine some of our viewers here today haven't been following this as closely as you. So, what's going on with Argentina? Why do they need a currency swap? And how is this currency swap relevant, and what are your views on it?
So Javier Milei, libertarian president of Argentina, did a big fiscal consolidation last year. Got a lot of credit for it. He did bring the fiscal deficit down. He says he turned it into a surplus. I would say there's some off balance. There's a quasi fiscal deficit at the central bank, but there's no doubt that there was a big fiscal adjustment. He did an upfront currency depreciation, which was necessary and important in the first part of 2024. But after that, inflation remained relatively high. The currency remained pretty tightly managed. Little bit of a crawling depreciation, but not much. And the peso in real terms strengthened a lot and became, in my view, quite overvalued. Argentina's current account, its balance of payments, turned to a deficit. So even though the fiscal accounts improved, the balance of payments deteriorated. And that deterioration wasn't covered by private flows. It was covered by selling reserves. Those reserves were replenished with an IMF credit line in April. The IMF credit line wasn't enough. Reserves were continuing to drop. And so essentially, Argentina faced a situation, and then there was, sort of signs in the Buenos Aires provincial election that Milei was losing political support and wouldn't do well in the October legislative elections. So it was pretty clear that Argentina was going to run out of reserves, run out of foreign currency, and be unable to intervene to prop up its currency, and potentially be unable to pay interest or amortizations on its exchange bonds next year without international support. And faced with that, the U.S. signaled a couple of weeks ago that they were willing to provide Argentina with a credit line. That credit line is being used as using funds from the Exchange Stabilization Fund, which is a pool of money under the control of the Treasury Secretary. It has roughly 22 billion liquid dollars, 6 billion in euros and yen, maybe 7, and then 170 billion in SDRs, special drawing rights, the IMF's currency. Republicans are usually pretty critical of uses of the SDRs, but we're hearing rumors that this is going to be funded out of the SDRs. The SDRs are basically converted into a certificate because the Fed can't hold SDRs directly. That certificate, which is a claim on the Treasury's SDR, is posted as collateral to the Fed. The Treasury gets dollars, which it then lends to Argentina. So this is, old-fashioned bilateral rescue package. What we don't know is whether it's going to be. I mean, Bessent's statement today suggests he's doesn't see a problem with the exchange rate. Interesting to me. I see a problem with the exchange rate.
Namely,
Uh,
that it's overvalued.
yes, certainly the problem is not that it's undervalued. Argentina is selling reserves to keep its currency from getting weaker. It's going into a current account deficit. Imports have been soaring. Tourist spending abroad has been soaring. All the usual indicators point to an overvaluation. And so we'll see if this is just a crisis of confidence that a Treasury credit line can solve, or whether there's a more fundamental problem, which is that there's an overvalued currency, and that overvalued currency is driving a current account deficit that Argentina can only sustain as long as is able to get new inflows from the rest of the world. And whether the Treasury is willing to double down, go beyond 20, put in more next year, we'll see. Argentina has already borrowed 56 billion from the IMF. No real prospect for immediate repayment. Apparently, some of this money is going to be used indirectly to finance Argentine buybacks of some of their bonds. Creative. But the problem with buying back your bonds when you don't have enough foreign exchange to intervene, and you have bond payments that are contractually coming due, is if you buy back your 20-year bond, you're using cash to affect the long-term market. That cash is not available to intervene in the FX market or to pay your current contractual obligations. So we'll see. It's an incredibly risky operation. Obviously, it's risky to buy overvalued pesos, as we did, the Treasury did today. It is risky to lend to a country ahead of an election where the incumbent administration may lose support and policies may change because they lack a democratic basis, democratic support. And it is risky to lend money to a country that has yet to allow its exchange rate to adjust. Mexico in 1995, the rescue line came after Mexico had depleted its reserves, but it also had let the peso depreciate. And so it's pretty clear that Mexico was going back into a current account surplus and was going to start generating foreign exchange. So my main criticism is that any support for Argentina should be dependent on a policy adjustment that puts Argentina in a position where its economy is generating a foreign exchange surplus. And that there's been too much attention on the fiscal metrics, not enough attention on the deterioration in the balance of payments, the continued fall in reserves, and the implications that has for Argentina's economy and its capacity to support more foreign debt.
So, Brad, as you know, a lot of the times the Treasury or the Fed does an intervention, and monetary hard money people say, "Oh my God, this is crazy." But at the end of the day, the Treasury or the Fed does not lose money, and in some instances reports a profit. In this instance, how are you assessing the odds that the Treasury, the U.S. Treasury, loses money on this stabilization of to Argentina?
I think the U.S. Treasury almost certainly will lose money on the peso purchases it made today, which is why I'm a little skeptical that was a wise use of taxpayer money. The odds are that the U.S. will get the money it lends to Argentina back with interest. So in that narrow sense, we will make money. The question is really not whether we're going to lose money, because rather than take losses, governments just extend and extend and extend. The IMF hasn't taken a loss on the money that it extended to the previous Argentine government, to Macri's government. They've just extended, extended, extended. So the real question is, do you get your money back? The IMF hasn't gotten its money back from its 2018 and 2019 loans. I think there's a very high probability the U.S. Treasury is not going to get its money back inside the current term of the Trump administration, inside Scott Bessent's tenure as Treasury Secretary. But I think the odds that the U.S. will lose are pretty low. Now, technically, the Exchange Stabilization Fund ranks below the IMF and the MDBs. The U.S. is not a preferred creditor. So in a global restructuring, if everything fails and you have to restructure, technically the U.S. could be part of that restructuring. I am reasonably confident that this was structured a little bit as a swap and as a credit to the central bank, so that you can differentiate between debts owed by the central bank and debts owed by the government, and thereby protect the U.S. from visible losses. So odds are not a loss, except on the direct purchase of pesos. If the U.S.
Mhm.
were buying Argentine government bonds directly in the market, I think there'd be a risk of a loss there too. But if you're just lending money to the central bank will probably be able to repay you. The question is whether they're going to repay you in 5 years, 10 years, 15 years, or 20 years, and whether it is a good use of the exchange stabilization fund, which is supposed to revolve, to have it tied up in a long-term loan to Argentina.
And will the Argentine central bank pay the U.S. Treasury back in dollars or pesos?
Dollars. The
Dollars.
commit.
Okay.
Well,
So yeah.
they're posting pesos in it, so the U.S. will hold pesos, but the U.S. is not going to settle the dollar loan by just saying, "Okay, we'll just keep the pesos." The U.S. wants the dollars back. The commitment in a swap is you get the dollars today, but you give the dollars back when the swap expires.
Mhm. Well, Brad, it's been so great having you here. Could you? I understand that there's, like on Liberation Day, like before Liberation Day, so much uncertain. But if you just could, try and sort of trace a summary through what we're seeing in balance of payments, and particularly the Trump tariffs and the Trump tariff plan, and what you see going forward.
Look, the Trump campaign tariff plan was more coherent than the actual Trump tariff plan. 10% across the board will generate revenue, and it won't distort the U.S. or the global economy that much. Hefty tariffs on China and modest tariffs on the rest of the world. You can debate the merits, but that will incentivize people to move out of China. What we've ended up with is some parts of trade having much higher than 10% tariffs, other parts of trade having zero tariffs. We've ended up with a smaller increase in tariffs on China than on much of trade with India and on trade with Brazil. We've ended up with 25% on auto parts from Canada and Mexico and 15% on auto parts from Japan and Europe. We've ended up with zero tariffs on electronics. We've ended up with 20% tariffs on Southeast Asia in general, and a between 20 and 30% increase in the tariff on China. There's still some legacy Trump 1 tariffs on China. That's not a big incentive to come out of China. And we've ended up in a world where the administration seems to have been caught by surprise by the ferocity of China's retaliation. And there's a possibility that we could have a deal with China that brings those tariffs down lower. So we've ended up with a tariff structure that has been much heftier on allies and friends than expected, less tough on China than expected, and with enormous gaps where there are no tariffs. The impact on the dollar was short term negative. The impact on flows, ironically, is that the AI boom has been so powerful and confidence in the Mag 7 so strong that we've largely seen a rotation from bond flows to equity flows. Uh, Less interest in funding the US government, more interest in buying US stocks. I think this has implications if the stock market turns down. And I think it has implications for correlation between dollars and equities in downturns. But it hasn't meant the world to stop buying US assets. And in equilibrium, as long as the US is running a current account deficit, someone has to be buying US assets. And even if most of the flows are hedged, that just means someone is putting short term money into the US and then swapping it, and someone else is buying long term bonds. So we haven't seen a cutoff of flows to the US. We've seen a change in composition. We've seen some change in price, the dollar, and we've seen some things go up in price, equities. Not a crisis. Uh, the economy has managed, powered through, offsetting shocks, and consumers have gotten lucky because a bunch of companies have decided to eat a decent chunk of the tariffs to date.
Brad, thank you so much for coming on Monetary Matters. People can find you on Twitter at Brad_Setzer, where you post a lot. And you're definitely one of the best posters on Twitter in terms of in-depth economic analysis. And your website is Follow the Money. We'll link that to the description, as well as your work that is posted on the Council on Foreign Relations, where you are a senior fellow. Thank you again. And thank you, everyone, for listening. A reminder to subscribe to the Monetary Matters YouTube channel, and also leave a rating and review for Monetary Matters on Apple Podcasts and Spotify. Thanks for watching. As a reminder, this episode of Monetary Matters is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs that give investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMHJack and SMHXJack to learn more. Until next time.
Thank you. Just close the door.